Let's talk Bitcoin. 2012, I was introduced to it. I started to accumulate. 2013, I wrote an article. And
so hold on, just so we know we can feel bad about ourselves, you're accumulating it at what price?
Well, my dollar cost average is around 100 and something. But then I wrote an article, and I said, you know what? There's so much asymmetric upside here. This is a thing that either goes to, at the time I said, roughly the value of gold. And at the time, it was about $100 a coin. And so there's very little downside. There's all this asymmetric upside. I said, take 1% of your net worth and buy this schmuck insurance.
That was at $100, though. What would you, I actually started hearing from people that I know very well who don't often invest, who are now asking me if this is the time to invest.
Buy the schmuck insurance now.
Here's the thing. This is now a confidence game, right? There is no real utility in this. This is a fantastic fundamental hedge and store of value against autocratic regimes and banking infrastructure that we know is corrosive to how the world needs to work properly. You cannot have central banks infinitely printing currency. You cannot have folks with, misguided and misdirected monetary and fiscal policy.
We've done okay.
You just called it a confidence game, which is a con game.
And we've done okay.
It's a con
the economy is built on central banks and built on fiat currencies, where you said yourself how much better life is in every respect than it's ever been, and that's with that as a infrastructure.
So we've seen the first few chapters of this, and now we have to go through this great unwind. Right, when all this liquidity now, what happens?
We'll see what happens.
We'll see what happens. And so all I'm saying is to have the ability to hedge that out in a way that isn't fundamentally correlated to the people and the infrastructure that made those decisions that we were not a part of fundamentally, I think is a smart thing.
But the point is, if you haven't jumped on this bus or train or whatever vehicle you want to describe it as, has it left the station?
No. So here's what I would say. The same way that I said in 2013, put 1% of your net worth into Bitcoin, I will put myself out there today. I think this thing is $100,000 a coin, probably in the next 3 to 4 years. And I think it is, in the next 20 years, $1 million a coin. So there you have it.
Hello, and welcome back to Cryptollennium. Today, we'll be talking about what is going on with Bitcoin, the reasons behind this rally, how Bitcoin is up 34% since Jim Cramer said it was a good time to get out of crypto.
It's never too late to sell an awful position, and that's what you have if you own these so-called digital assets, which may not be worth the paper that they will never be printed on.
The fact that the Bitcoin RSI copies the 2018 bear market recovery. Are we in a dead cat bounce? And we'll revisit some key indicators before we close. So without further ado, please like and subscribe, and let's dig in. Bitcoin is due for a new big rally as the RSI copies the 2018 bear market recovery. Bitcoin prints a never-before-seen bullish divergence. A key phenomenon now underway sets Bitcoin's latest recovery apart from all the others. So the RSI, he noted, on January 18th had printed a long-awaited bullish divergence on weekly timeframes, something which has never happened before. For those of us unfamiliar with the RSI, it's a fundamental gauge used by traders to determine whether an asset is overbought or oversold at a given price. Technicals were there, charts were screaming bottom, but as usual, majority was in full bear mode, Wolf added. Some are saying that some consolidation will proceed, more upside. With that, Bitcoin is beginning to repeat the kind of renaissance last seen at the end of its previous bear market in early 2019. On daily chart 1, RSI's strong uptrend, 2 overbought zone, 2, BTC had a significant drop before that, 3, sudden buyers bought up Bitcoin, big rally will be followed after some consolidation. As seen here, 1 on the RSI, 2, the significant drop, and 3, sudden buyers buying up Bitcoin, big rally will follow some consolidation. So who are these buyers? Really quick, let's go take a look. Data from Sentiment, on-chain data aggregator, shows that one of the main reasons for such a big price jump is the recent activity of a large group of whales of higher tier. These wallets, the company's analysts say, hold between 1,000 and 10,000 Bitcoins. Over the past 2 weeks, they have collectively bought $1.46 billion worth of Bitcoin. This is equal to 64,638 Bitcoins. Per a sentiment chart, these whales were actively selling their Bitcoins between February and December last year. Now, over the past 15 days, they resumed aggressive purchasing. The fast growth of Bitcoin explains the rest of the cryptocurrency market trading in the green at the moment. So the same people that were dumping last year before Luna crashed are now jumping back in. Food for thought, but not financial advice. So in addition to this, the Bitcoin price managed to reach 23,300, but the market is not overheated according to two indicators. As we all know, many speakers on crypto Twitter are sure that the ongoing Bitcoin spike is too fast and would be erased very soon. However, at least two reliable indicators look amazing for bulls, CryptoQuant's verified author says. So according to them, Bitcoin upsurge might be continued as OI and estimated leverage still at lows. In his recent analysis highlighted by the team of CryptoQuant, a top-tier on-chain data provider, Dan Lim displays two indicators that are lagging behind the Bitcoin price. In a quote directly from CryptoQuant's Twitter, looking at the open interest and leverage ratio, they have fallen sharply since the FTX incident. And despite the recent strong rally in Bitcoin, these two indicators still haven't overheated at all. So Bitcoin's price, open interest, leverage ratio. As we can see, this dip right here is around the time that FTX made their debut as a big fail. So while the Bitcoin price itself has fully recovered from the phase of its collapse caused by the FTX Alameda drama, both metrics are still near multi-month lows. First, it is aggregated open interest, i.e. the US dollar denominated value of all open derivatives positions across verified cryptocurrency trading platforms. This metric mirrors the activity on the derivatives market. Aggregated OI bottomed in mid-December and is only in the middle of a pale recovery. Then we have the estimated leverage ratio, an indicator of the leverage rates derivatives traders choose for their positions, bottomed last week and still fails to get back to December 2022 levels. And that is why most interesting developments in the midterm are yet to come for Bitcoin bulls, Lim supposes. In addition to all of this, in the last 24 hours, the Bitcoin price gained 8.8%. As per estimations of CoinGlass, $385 million in derivatives positions were liquidated. Thor's responsible for 80% of this. Not to mention, we are now seeing the crypto market break above $1 trillion in total value. Now, could this be a dead cat bounce? Bitcoin price nears 23,000 in a fresh 5-month high. Now, this is before we broke 23,000 from earlier in the day, but there are still some interesting points made. So the bid liquidity causes suspicion. As noted by intraday trader Skew, Asia was leading the way into the weekend with sell-side pressure from market makers being absorbed on exchanges. On-chain analytics resource Material Indicators, meanwhile, flagged ask liquidity being removed on Binance the day prior, this allowing Bitcoin's initial run beyond the $22,000 mark. As ever, Bitcoin was far from above suspicion at its latest highs, with some familiar faces still urging traders to prepare for the worst. The bigger the pump, the harder Bitcoin will fall, analyst Tony Guinea tweeted, while Crypto Tony argued that the entire move may be nothing more than a dead cat bounce. Listen to what they say next. Regardless if this is a dead cat relief wave or a reversal on Bitcoin, it is great to see some optimism back in crypto, but considering why further gains were coming after the end of the week's TradeFi trading, one popular commenter additionally suggested that traders were being manipulative. In quote, "No one who genuinely wants to buy and own crypto waits until Friday's close each week to execute," an update read, adding that those buyers' aim is clear. And if you noticed, last week we did see the surge on Friday as well. Earlier in the week, Material Indicators had likewise warned of choreographed bidding on Bitcoin. There's a key moving average on the horizon. Attention thus focused on the upcoming weekly close for Bitcoin/USD. If the current prices were to sustain, would be its best since mid-August. So in tandem with this surge, Bitcoin looked to be about to print a so-called death cross on the weekly chart, with a descending 50-week moving average about to cross over the still rising 200-week moving average. Right here is where they would meet. Now, if it gets rejected, we all know what's going to happen there. A major target was the 200-week moving average, currently at $24,650, out of reach for much of 2022. If we do see that point crossed and sustained, it's safe to say we'll see possibly a sub $30,000, maybe low $30,000 Bitcoin. Not financial advice. This is all speculation as we are in a bear market. And finally, we will revisit some of the most popular Bitcoin indicators. So here we have the 2-year moving average multiplier. As you can see, we're starting to move back up. It does look like previous bear markets, but there are always fake outs. As you can see right here, there was a fake out in 2015. Not as dramatic in the previous cycle, although we did briefly go back down under the moving average multiplier, and that was the COVID crash. Currently, we're working towards it, but that does not mean we can't get rejected anywhere between here and there. So if you didn't know this, the 200-week moving average is usually around where Bitcoin has bottomed in previous cycles, and that is why it's used so much. Bitcoin does seem to be trying to reclaim its position above the 200-week moving average, but we really don't know until it closes above it because it is a strong line of resistance. So here's the Bitcoin stock to flow model, and it basically outlines the number of Bitcoins available to the market relative to the amount being produced each year. It is completely deviated from the predicted line, and this is a generational opportunity according to this chart. Although this is not financial advice, this is just another great indicator just to show you relative to the previous cycles how much we have deviated from the norm. With this said, a lot of good news, some bad news. We don't know where we're at quite yet because we haven't seen closes above certain key resistance levels. Keep an eye on the market. This is a promising time to be in crypto. If you made it this far, please like and subscribe, and we'll see you tomorrow.